Hello friends, this is Miriam Hippolito, a Forex and cryptocurrency expert at Traders Union. Today, we'll talk about boom and crash, unique types of indices used for trading. If you're just starting to explore trading, this video will be useful for you. So let's start. What are boom and crash indices? Boom and crash indices are special trading instruments often used on platforms for automated trading, such as Deriv. These indices move in a specific way. Boom generates sharp spikes upwards, while crash generates sudden drops downwards. These movements can occur unexpectedly, which is why they attract traders who enjoy dynamic trading. How does it work? The movements in boom and crash occur randomly, but there are certain patterns. For example, in boom 500, the probability of a sharp rise increases every few candles, while in crash 1000, drops happen more frequently. Beginners can look for such moments to open positions, but it's important to remember the risks and use protective stop losses. Trading tips for boom and crash. Trade with small volumes, especially if you are a beginner. Use indicators such as moving averages and support, resistance levels. Always set stop losses to limit losses. Do not enter trades without a clear signal. By following these rules, you can minimize risks and learn to use boom and crash effectively. Boom and crash indices are excellent tools for active trading, but the key is to trade wisely. Subscribe to the channel, like the video, and comment on what topics you'd like to see next. This has been Mirhan Hippolito and the Traders Union team. Good luck in the market, and see you soon.